right now we're kind of going to stay focused on just a few key things about multi that Mark has a great message for us all. So maybe Mark, you can maybe kind of give us a little bit of your story and your over your 18 plus years.
Yeah,
and then
sure.
we'll get into some chatting.
Sure. I'll maybe go back. I'll go back to just when I was in school, and how I got into the analytics and research space. So I in university, my plan was to kind of be an economist, and so I took economics year one, and then year two had to do kind of year two university calculus, and that didn't work. I just didn't do very well in it. And so that kind of for a moment kind of that wrote off anything to do with math. And so I was like, okay, let me go into marketing. I'll do marketing. That sounds easy. And through my marketing program, I had to take statistics. That was kind of part of it. And I fell in love with statistics. I ended up taking more statistics than was required, doing regressions and modeling by hand on kind of pen and paper, just understanding the concept. I really, really liked it. And I found that, statistical analysis, a lot of people were afraid of it. I enjoyed it. I saw the power of it. I saw what it could do from just an understanding, human behavior. And then specifically kind of shopper behavior and consumer behavior where I went. So then I worked in the corporate space, so care operations for about 4.5 years, which is the owner of a bunch of restaurants. They've rebranded now to Recipe. They own, at that time they owned, Second Cup, Harvey's, Swiss Chalet, Kelsey's Montana, so kind of big conglomerates. I worked within a little consulting kind of group within that company. And then I guess 4.5 or so years later, jumped ship with two people that I worked with there we're kind of the first of three of a marketing research company, that worked with global brands, Procter & Gamble, Nestle, a lot in the consumer packaged goods space, Bombardier, recreational products, CCM hockey, so, eBay globally. So those are some of the clients that I worked with, and it was cool because I, got to travel a lot, got to deal with some really smart people around the world. And my job there was to essentially, paint the picture or give them the unbiased view of what people thought of their brands and some of the things that they were going to come to market with. And so I spent a lot of time in the branding space. So the position of branding, not just creating logos, but branding strategy, figuring out how to position your brand for success in a bunch of different marketplaces. And so I'm actually just in the middle of exiting that company now. So it's that's really cool. So it's been a long time, but I've now kind of shifted my focus 100% to real estate and kind of started a real estate company about 5 years ago, Peak Multifamily Investments. And we just recently with one of my business partners started an arm or a division dedicated specifically to multifamily investing. So Peak Multifamily Investments kind of deals specifically with apartment buildings. And I'll get into kind of that model in a moment. So kind of through my path, that's, branding and marketing, obviously is very important. And I spend a lot of time branding and marketing, as you'll see, kind of my own business and positioning it and really catering it to, my target market, which are people that understand the value of real estate, want to get into it, but don't have the time or experience to do so. And so we partner with people like that and execute on, number of projects, primarily multifamily investing, which we'll kind of get into in a second. So that's kind of the long-winded story of how I got into real estate. I'd say I think most people I talk to that get into real estate wish they had started much sooner. I too kind of fall into that bucket. My wife and I talked about it for probably 5 or 6 years, and then finally it's like, okay, let's get moving. So it's been about 5.5 or so years where I've been investing in real estate. Done a bunch of different strategies. Started with wholesaling, then house flipping, then moved into buy and hold, and now buy and hold at apartment buildings. So apartment buildings have been about 3 or so years. Still do some house flipping. That's a well-oiled machine to some degree. I don't do the renovations myself. I have a partner that does all that, but I just deal with the financing and the acquisition side of things. So yeah, so long-winded, you know, intro to my story. Where should I go from here, Marco?
Well, God, there's so much. If this is a success, this call, I guarantee I have a few more topics for you if you're willing to come back and
Sure.
chat with us. So, but so let's I just maybe just a blurb. I think I mentioned this to you. I was listening to your podcast on like 1.2 or 1.5 speed, and I'm like taking it in, and I'm like rewinding it because sometimes it's like it's kind of fast and stuff. But maybe can you kind of just before I start with our key questions, maybe give us a little understanding of like your mission there.
Yeah. So yeah, so great. And I would have forgot to mention that in my intro, but thanks for that.
Mhm.
So I mean, so the purpose of the podcast. So I was in the United. So I'll back up a little bit. So I was in the United States last year in July, and I went to a multifamily investment conference. So kind of big players in the United States, and my purpose there was just to see how they're scaling their businesses, because they 10 times the population. They're scaling it in different ways there.
Yeah.
So
Yeah.
I went there to connect with people to just understand how they're scaling. Not so from an acquisition standpoint, from a capital raising standpoint, as well as just an operation standpoint. How are they doing that, so that I can kind of bring that knowledge and do the same here. What I noticed was that there's a lot of great podcasts, real estate podcasts in Canada, and there's a lot in the United States. In the United States, there's a couple that are specifically focused on apartment buildings, and there was really nothing that existed here in Canada dedicated the whole show to apartment buildings. So kind of with my marketing and branding and positioning background, I was like, okay, we need to start something like that. So it's part of a content marketing strategy, but the mission of the podcast is to democratize essentially apartment building investing, and it's to bring more awareness to the strategy here in Canada. And our objective on each of the episodes is to interview guests that are very experienced, as well as those that are starting out. Some of the episodes that we have kind of in the queue that are about to launch in the next couple of weeks are some very experienced investors in the multifamily space in Canada, as well as we interviewed a guest the other day that's brand new, that doesn't have an apartment building yet, but with him and his wife, they're raising capital. They're about to get into it. So the purpose is really to share stories so that other people can hear these stories. And the takeaway, we hope, is that anyone can get into it, right? It's not about you need to be have a ton of money or be a millionaire to get into it. At any position, any state in life, you can get into it. And so what we found in talking to newer investors, and we've confirmed this with people, talking to a lot of people, as well as people that just that are very experienced, kind of recalling back when they started.
Yeah.
There was a psychological barrier of and how do I get into something so big, right? And so the purpose is really to break down kind of the psychological barriers to getting into multifamily investing, whether it's wanting to be a passive investor or to become an operator yourself. And we hope that people that listen to the podcast, as well as we do a ton of webinars, the purpose is just to educate people, to give people the fuel, the knowledge to perhaps take that next step. Again, whether they're going to do it on their own, or if someone is going to be a passive investor in a project, such as ones that we may offer or others may offer, you should at least be able to analyze it and understand the mechanics of it. And so that's kind of what we're teaching and what we're putting out there. And yeah, so far we've gotten some really great feedback in terms of just kind of meeting that objective that we have.
That's so interesting. That's so nice to hear.
Are we back?
So should we start with the first question?
Yeah.
So yeah, so you're gonna go?
Oh, yeah. Okay. So why are apartment buildings, in your opinion, considered a recession-proof asset class?
Yeah, so I mean, so it's a recession-proof asset class. Now, I think where we are today, in the crisis, COVID-19, not really a recession, although there are recession-like indicators and the economy is tanking. So, it's not spurred upon by financial issues, although it's causing financial issues. So why it's a recession, and it's long been known as the recession-proof asset class compared to stock market, and compared to other real estate asset classes such as office or industrial or retail, for example, which is getting hit hard right now. And some retail sectors, even office space, may not feel it yet, but likely will. And really, the premise of a recession-proof asset class is that when times are good, right? So when the economy is really strong, typically housing prices. So a couple things are happening when times are really good. People are coming into the country, right? So especially being in Canada with our immigration policies, people are coming in, right? So there's kind of more demand. Also, housing prices tend to go up when times are good, so making it less affordable for people. And the premise that everyone needs a home, right? Everyone needs a home. And right now, especially in Canada, but more specifically in Ontario, there is a shortage of housing. And so, so when times are good, prices of single family are high, making it less affordable for some people, but they still need to, be housed. And so rent demand goes up. When times are bad, people can't afford housing, or buy housing. They turn to renting. So in both scenarios, rental housing has very high demand. Even right now, so I look at my portfolio, and I can speak to others as well. As I look at April and May rents, that it hasn't gone down. Like I have one, I think I'm at 9, so I was 100%. And this is across four apartment buildings and some single family duplexes. 100% rent in April, 95 plus, waiting for a couple other people that are typically late anyways for May. And I compare that to other, real estate asset classes that are having trouble kind of collecting rents from their tenants, whether it's commercial tenants. Now, industrial is doing really well. And so again, in good times, people need to have, place to rent, and in bad times, people need a place to rent. That's kind of really the premise of why it's a recession-proof asset class. That's why I got into it in the first place. Because when as I mentioned, with house flipping, it's a very volatile strategy. It's a high risk, high reward strategy. And so I needed something to kind of balance that out. And so that's why I started getting into buy and hold and eventually multifamily apartment buildings, is because it is much more stable. It's not a get rich quick asset class at all. It is for the long term. But because it's long term, it has its stability. It's very stable.
Yeah, that's so true. So, but do you see, for example, certain certain types of, do you feel like buildings are more recession proof than, let's say, smaller, like houses or let's say duplexes or something?
I think so. My personal belief is yes, owning both, right? I'm more worried about my duplexes, because, one person leaves, that's 50% vacancy, right? Whereas in, a 14 or 20 unit building, one person leaves, that's, a fraction of the vacancy rate, right? So I think with scale comes stability, right? With scale comes a ton of synergy, right? So, in a 12 unit or 20 unit building, we're dealing with one boiler, one roof. Yes, the costs are higher to service these, pieces of equipment, or, capital expenditures are higher. And so that's perhaps maybe the downside of the trade-off. But because you have so many units and residences under one roof or in one property, that provides you, some of those benefits of, stability, and synergy.
Yeah. Does anyone have any questions, or should we move on to the next? Although I feel like the next. Yeah, go ahead.
If you don't mind me asking a question, Deanna. Yes, Mark, you kind of mentioned briefly on, the democratization of investing in apartment buildings, right? So in terms of, being having access to capital. I mean, being able to buy an apartment building, it does require a lot of capital, more than 20% or something like that, right? So how can you just lend some advice as to how to get into something like that, an apartment building?
Yeah. So I
If
think
you don't have if you don't have that much money.
yeah, for sure. So I think that's really, so I love that question. And I think that's really the purpose of, you know, the stuff that we're putting out there, and specifically the podcast, because, you know, in fact, I'm trying to think of all my guests that I've had on there, but most of the guests, actually maybe, okay, I'll say most, perhaps all of the guests are buying apartment buildings with not just their own capital, but with other people's money, right? So they're raising capital to buy apartment buildings. So, and that's kind of the purpose of the podcast, is that, so that is kind of, I think, one of the main or primary, I would say, mental hurdles or psychological barriers that people face. Well, this is so much money. How am I going to get, you know, $1 million, let's say? So I would say even the 20%, it's not 20% down. It's probably going to be, you know, 30, 35, sometimes 40% down, right? So that's kind of one of the first things to remember, is that it's the financing, and Marco, you and I are going through this right now. Like, the financing of an apartment building is not like single family. So it's not, you know, 80%, although it can be, but it's not 80% of purchase, it's 80% of value, right? So the difference between what you buy it at and what a bank's going to value it at, you know, it's very, especially right now, because the asset class is very hot. It's always been a very popular asset class. So people are going to pay more than what the bank will value it at, because it still works out. So back to your question, which is with how do you buy without, you know, all the money? It becomes raising capital. And so what I've done, and that's kind of where my marketing background and branding background kind of, you know, fuse with my real estate business, is, you know, you create a brand. You create a brand, whether it's a personal brand or a corporate brand, to position yourself to attract, you know, joint venture capital to help fund the purchase of the buildings. That's what I do. So, you know, again, people I work with understand the value of real estate. And if they don't, then I can educate them on that. They have capital that they want to place in an asset class that is a little, you know, stable, especially right now. Like I have a project going on right now where we're almost fully raised, and there's a few investors that the reason why they're coming into this project is because the stock market is just it's way too volatile right now. And that's you know, made an impression on them, and so they want to put their money away. That's it's something more stable. So you have to raise money, right? So you don't have to have all the money yourself. You become a marketer, really. You become someone who's going to attract people that want to get into the asset class or want a stable return on their capital. Your solution to that, yeah, you know, I'm assuming you want to get into buildings. My solution to that is apartment buildings. And then I do, you know, from my business model, you know, it's hands-free for my capital partner. So I find it, I acquire it, I, you know, deal with the financing, I deal with the legal, and, you know, have the systems in place to manage it from front to end. So hopefully that answers your question. So if you don't have the capital now, it becomes an exercise in raising capital.
What kind of ownership share do you acquire the properties through? Is it like a joint venture agreement, or is it, you know, like a
corporation, or
no, like there's different type of like shares that you can own property, right? Like
Yeah.
Are you asking if you're on title, or is that what you're asking?
No, there's different type of shares, like
like limited partnerships and things of that nature. Is that what you're thinking? Or preferred shareholders, rather than like selling blocks off, maybe? Is that what
I think she's talking about joint tenancy or tenants in common, maybe.
yeah, exactly.
So here, I'll tell you. So I've done two ways of structuring my deals. One, kind of a typical joint venture partnership. So I'll say typical, That's all. Let me explain it. Where we just enter into an agreement. Basically, you know, my capital partners come in, they get a share of the building. I've done 50-50, I've done 60-40. My most recent one, actually, the capital partners own 75%, and myself and my kind of firm and partners own 25. So it really depends on the deal. The main reason for that is I want my investor partners to make anywhere from 15 to 20% per year. So I adjust it based on that. So it could be a joint venture partnership, which is basically an agreement that says, we're partnering together, and we agree to, I manage it kind of day to day, and we agree to split profits. So it's a very simple, that's kind of my first buildings is what I use a joint venture partnership. The agreements and the arrangements I have now, and on my most recent one specifically, is the building. So we create a corporation. In fact, all my buildings, we have a corporation. So we create a corporation. And for example, this one I'm doing in Barrie, which is a 12 unit, it's on Sanford Street. So the corporation is 94 Sanford Street Corporation. The building is owned by that corporation. Myself and my operating partners are the directors of that corporation. And so it's us that are qualifying for the mortgage. And so, you have to qualify for commercial mortgages, and they look at, net worth statements. They look at your experience. Are you experienced to operate, a venture or a building like this? So they look at that. And then so our capital partners, we're all shareholders. So we all kind of are buying units in this corporation. So the operating partners, such as myself, we have our Class A shares, which are voting shares, and then our capital partners have our Class B shares. In total, the capital partners are going to own 75% of the building, and myself and my operating partners are going to own 25% of the building. And so that's how we structure. So essentially, it's a again, just to recap, it's a corporation, and we each own shares in that corporation.
Mm-hmm. Yeah, it's probably if you're having many people, or just because it's a building, it's probably easier to do it in a corporation.
Yeah, and we do it for just liability. It's a separate entity. I don't want it tied to any of my other assets.
Mm-hmm.
It's a separate kind of, just more for a liability standpoint. It runs on its own. It's going to have its own financials. We have to file for taxes every year because it's a corporation. It kind of keeps it much cleaner from an accounting standpoint, but also more specifically from a liability standpoint. Mm-hmm. It's a separate entity. And as the portfolio grows, you kind of want to have, at least, for me anyways, want to have these things as separate entities. And for example, let's say you're a shareholder on, property C, you don't have anything to do with property A. So I want to keep it all separate.
Mm-hmm. Yeah. And I have a question, actually, just going back to comments that you said, that if you could just share with us, what are the differences between, you're saying how getting financing or just like, I guess, buildings compared to houses or townhouses, mm-hmm. In just any sense, like what differences you noticed when you're acquiring a house compared to like a multi-unit building?
Yeah, great. So that's the foundation of really apartment buildings, is the valuation part of it. Why, the other reason why I got into it as well, because again, I had single family duplexes, et cetera, and a fourplex. So anything essentially, depending on the lender, anything 5 units or less is considered kind of residential or is financed as a residential mortgage. Some lenders will do 5 units as commercial. Anything above that, so let's say 5 or 6 or 6 plus, is considered a commercial property and is financed as a commercial property. So the difference between commercial financing and residential financing is the valuation method. So, each one of, if you own a home, the value of your home is highly dependent on the value and a comparable sale of your neighbors, right? So that's the comparable sales method approach. So they're going to look at your house. They're going to look at what recently sold in your neighborhood, you know, how are the renovations in yours? How are the renovations? And then come up with some sort of comparison. So it's highly dependent on what your neighbor does, right? Whereas commercial valuation is based primarily on the value it brings financially. And what they look at, you know, primarily is net operating income. So if you have, you know, building A next to building B, the building A is generating net operating income of 200,000. It's the exact same building. It's the exact same size, exact same infrastructure. Everything's exactly the same. The renovations are the same, all that stuff. Building A is bringing in net operating income of 200,000, and building, you know, B is bringing in a net operating income of, you know, 250,000. The value of that building is going to be more than building B, more than building A. That was one of the other reasons why I love, kind of because of my business background. I felt like, and I feel today, that I have more control over growing the value of that asset class than you know, residential. I can do things to increase the net operating income, you know, which is basically growing revenue, or reducing operating expenses. And so I could and that's really our strategy, is, you know, buying buildings that's the value add strategy, buying buildings that we believe have suboptimal net operating income. We're going to apply kind of our process, which primarily involves increasing rents through improving the units. And then at the end of, you know, let's say a 3, 4, 5, 6, 7, depending on the project, let's say a 5-year period, the net operating income is going to be higher. And that difference is really the value that we've created for our partners. So the valuation is, you know, based on net income. We just did, actually this year, I can send you guys the link. We've done a series of webinars over the last month or so. We've done 4. Of the 4, 3 of them are specifically about how apartment buildings are valued. This, you know, net operating income, cap rates, and then our last 2, we had to break it into 2 parts. We actually go through the spreadsheet and the analyzer that we use, and we analyze a deal that we're analyzing now, a 20-unit building in Hamilton, and what you know, you have to consider as you're analyzing deals, the things to look for, how to do it, what's the difference between how a bank values your property compared to what you purchase. Because oftentimes, especially now, you know, in the example that I show in that webinar, we were looking at a 20-unit building in Hamilton. It's, you know, I think it's 2.75 million. That's what we would be, in fact, we'd be willing to pay more than that. We'd probably be willing to pay 2.95, but the bank is only going to value it based on their conservative calculation, 2.3, let's say. Mm-hmm. So going back to, I think, Trami's question, which was, is it 20% down? Well, it's probably about, for that building, it's going to be 70% down of the bank value. So you have to make up the difference between what you pay and what the bank values it, plus the 30% down, right? So anyways, that's all, you know, happy to share those links, the recordings and replays. You can sign on for that.
So are you buying based on future potential value then?
Yes. Yeah, absolutely.
Okay.
So we look at it. So, you know, that's why, you know, we it's fine to, like, for us, we'll overpay, right? As long as we hit our annual property ROI targets, which are 30, for us is 30%. So we're not going to get into a building if it doesn't do at least 30% per year. So 150% over the course of 5 years. If it doesn't do that, then it's really not worth kind of our time, because there's, you know, now it takes time to find those. You got to be creative. One of the things that we talk about a lot is that deals don't just fall into your lap, right? It's very rare that, you know, something's going to come across your desk and it's, you know, 30% ROI. That would have been snatched up already by somebody. You have to get creative in, okay, how can we make the numbers work? And I don't mean make the numbers work by you know, setting unrealistic assumptions. How can we do it through creative financing? What renovations can we, if the market average is at $1,400 per unit, can we get it to 15 realistically by adding certain things to our units? So yeah, to answer your questions, we are buying things on the future potential, and that's really what the value added strategy is all about.
Yeah, sure. So just so two parts again. One was just how you're sourcing the properties. Like, are you like reaching out to all the property owners and stuff like that, and similar to wholesaling, how you're acquiring your properties? And then the second part is around just capital raising. I know with SEC here, like you can't just approach anyone or put ads on the internet that you're looking for capital raising. So you need to be acquainted or have like sophisticated investors here in the US. So I'm just wondering what the rules are in Canada with getting capital.
Mm-hmm. Cool. Yeah, good question. So I'll address the sourcing the deals first. So again, the difference between residential and commercial apartment deals. So there's a difference in terms of how you get the deals. A lot of the stuff that we're looking at is not on the MLS. So, you know, I guess it's considered off market. I don't really consider it off market because in the commercial space, most of the transactions and deals happen, you know, before it even hits the MLS. And it's not because it's off market. There's still brokers involved and sales agents involved. It's just, I know a lot of times the sellers and the agents don't really want to put it on MLS because then you get a lot of tire kickers, you know, coming to the property or even inquiring. There's a network of, you know, buyers and sellers in the commercial space that kind of just transact before it even hits the MLS. So if I'm a selling broker, I'm going to have a list of people that I know are going to be able to close and that are seriously looking for, you know, apartment buildings or retail space or et cetera. So I'm going to go to them first. And it's very likely that, you know, that list of buyers is probably going to, you know, one of them is going to take that property and buy it before, you know, before anyone else. If for some reason it doesn't get bought in that kind of, you know, let's say back room network of buyers and sellers, then it might go to the MLS. So by the time it gets to the MLS, it's probably gone through, you know, a bunch of different hands and been passed up by, you know, by a bunch of people. Now, not to say that buying on the MLS is bad. I bought buildings on the MLS. One of our first was on the MLS. Interesting enough, it was on the MLS for 400. It was on the market for 400 days. And the reason why is because the deal fell apart 3 times by people that were trying to buy it that weren't familiar with the space and just didn't come up with the capital, enough capital to buy it. So that we ended up, fortunately enough, we ended up getting a crack at it and we ended up buying it. You know, we source leads through dealing with and connecting with, networking with brokers that are focused on apartment buildings. They go directly to sellers. They have a good relationship with sellers. We have started our own marketing to sellers, you know, for the buildings that we're looking for, kind of the 12 to 25 unit range. And but it takes a long time. It takes, you know, it's a long process. It's not like single family that happens a lot quicker. So I think for people that are starting out, you know, networking with the right people, right brokers, those brokers should have good connections. You know, look on the MLS because stuff will pop up on the MLS, but a lot of times the majority of stuff is kind of, you know, it's quote unquote off market. Oh, and then sorry, the sourcing the capital piece. Yeah, so similar to the US, you can't, you know, unless you're, you know, you're registered, you have a, you know, a REIT, and you have an offering memorandum, you can't, you know, advertise and say invest with me, right? So, pardon? So how I do it. So again, yeah, it's with accredited investors or people that I you know, that want to partner with me, right? So I never talk about kind of investing. It's, you know, it's more partnering, and I have to have some relationship with them, right? And so how I generate a relationship with them is they come, you know, they see the podcast, they come to our webinars, they're engaged kind of in the content that we're putting out there. They're on my email list. we have conversations over time, and then at some point, you know, I might have a deal, for example, like one I'm working on right now, that I'll put out there to my list of, you know, people that I have a relationship with, and see if they're interested in partnering in kind of one of my projects. Or they may come to me and say, hey, do you have any projects that I can, you know, I have capital that I can partner with you on. So it kind of works both ways. So I don't outwardly market, hey, invest with me on any platform, you know, at any time.
Okay, that's interesting. What about, so I'm curious about what have you seen with COVID and like the difference maybe between like the pandemic and recession, and if you see any differences, or in multi-buildings, you know, it's one and the same and there isn't much impact?
I think right now, you know, I think the LTB being closed, right, is a different dynamic that we've never really experienced before. You know, the good thing is that the federal government is pumping money back, you know, into the economy through these, you know, a lot of these programs that I'm sure you're all aware of. And so that's helping tenants, you know, pay for their rents. Yeah, I think it's different. It's going to be different than, you know, recession, in that, you know, in a recession, there's still a lot of people that need housing, and still, you know, a lot of people need housing now. The other thing is that turnover is a little slower right now. So people moving out of, you know, your units to someone else, that's slow right now, just because it's hard for people to show units. And so that's kind of taken a slowdown. But I think going through this period, again, kind of reiterates, you know, not that I needed more convincing of the asset class, but kind of reiterates, I feel very comfortable that I'm in, you know, apartment buildings going through this time, as I look at other real estate asset classes and the troubles that other commercial asset classes are going through. I feel, you know, that being in apartment buildings was a good, and that's why, and I jumped into it in the first place, was because I needed some more stability in my portfolio.
Mm-hmm. Does anyone have any questions?
Yeah, sure. Can I ask, Diane?
No, go ahead.
Thanks, Mark, for your time today. So, Mark, basically like a scenario. Let's say we have 20 people on this call, and each one has some sort of money to contribute to purchase the asset. How would you structure the deal working with you, actually?
For one of your own projects or one of my projects?
Let's say your project. Let's say by tomorrow, you know, Diana convinced all of us to say, hey, put 100,000 each and let's conquer the world, right?
I like that thinking.
Yeah. So, you know, and everybody will have money, and now we need to talk to Mark.
Yeah.
So, Mark, can you share a little bit on one is how you're going to structure that deal between your company and this group here? Second is, can we talk as well? Some people will have cash and RSP, right? So it will be a variation of funds. So can you share a little bit of your insight on that, please?
Sure.
Thank you.
Yep. So good question. So in terms of deal structuring, so similar to the ones I've done in the past. So basically set up. So assuming everyone has the same, objective in terms of holding something long term, right? They're in it for the long term. They're not in it to, you know, get rich quick, right? This is again a long-term asset, something stable. We would set up a corporation, right? So I guess there's two scenarios. One, I may be working on a deal which I can bring people into, or let's assume I don't have any deals right now available. Then I would show you my model. I would say, here, you know, if you're interested in this model, you know, it might take, you know, 3 to 4 months to find a deal that fits kind of the profile. And my profile, again, as I mentioned, you know, the property needs to do about 30%, so that my capital partners are making anywhere from 15 to 20% per year, kind of over the course of the period. So we would set up a corporation. The corporation buys the apartment building, and then as capital partners, you would be shareholders in that corporation in proportion to the capital that you know that you would be interested in putting in, and essentially, you know, you're an owner. You're an owner of the corporation. I'm a day-to-day operating owner, so I deal with the acquisition, the legal, the financing, all that stuff. With a group like this, I take on the mortgage guaranteeing. It's just way more efficient versus having to go to 20 people to get their financial statements. You know, I and my partners, my operating partners, can qualify on our own, so that simplifies things a little bit. So you don't have to have any qualification documents. That makes it a little bit straightforward. And then you basically are a shareholder of the company. You get a share certificate. You get your annual financial statements, just like any other shareholder of a company would get. Then I'd go find a building that's large enough. So let's say there's 20 people here. Let's say everyone had 100,000. So 2 million. With 2 million, you could probably buy. Do some quick math here. At 2 million, you could probably buy a building that. Probably a $5 to $6 million asset class, right? With at the purchase and then upside, a pretty big upside. So that's if that is of interest, you're happy to talk to the group or have a separate call of that with that. But that's typically how it works. The last few projects I've purchased it and then raised. Some of them I have had a group of people that said, "Hey, I want to partner with you. We're all committed to, once we find one, we're going to kind of move ahead." So I think that's a scenario that you're talking about, Nazir. That was your first question. Was there another question?
The different funds, right? So cash versus RSP stuff.
So on these types of projects, I don't do RSP. I have done it. I have used RSP funds as second mortgages on some of my projects. These types of the types of projects that I'm talking about with regards to the buildings, they're non-registered funds.
Makes sense. Is it just because it gets more complicated?
Because so I'm not a trust company. I don't have a real estate investment trust or a REIT set up. So that's kind of the next. I've looked at that. I don't really want to go into that space at this point. There's a lot of extra kind of work and the cost of capital becomes a little more expensive at that point. A lot of administrative headaches. So there's pros and cons. You can have professional money raisers, right, do the work for you, but there's also a lot of costs involved. So at this point, again, people that I know and come to contact, or business associates, are the ones that are really putting their capital into these projects. And so with that, I don't accept or can't accept RSP type of money. Now, like I said, I have used it for other types of projects as second mortgages.
Mm-hmm.
Hi, Mark. It's
Hey,
Deborah.
How are
Nice
you?
seeing you again. Good.
Yeah, good to see you as well.
Just a question. You were saying typically the buildings that you would be interested in, you said there were 12 to 20 units. Is that right? The
Yes.
typical size?
Mm-hmm.
So I was just wondering, so ideally, how many capital partners do you normally bring into projects that size? And what is sort of the minimum that people would have, the capital partners would have to invest?
Yeah. So the minimum is 100,000. And so some projects, like for example, this project I have in Barrie right now, there's 5 capital partners. The total raise is 720. So we're at 600 right now. So we're at 120 kind of left. So that first 600 is coming in from 5 people. I have another building where the raise was 875 or so. That was 3 people. So it depends on the project. I have one investor who just wants to do it on his own. So we're kind of just, Nazir, as you mentioned, he has a set of capital. and he just wants us to find kind of a building that fits his profile. So there'll be one. So it really depends on the project.
Okay.
At the minimum, it's 100,000 just to make it administratively worthwhile.
And it's usually, it sounds like it's usually under 10 working partners.
So
10
far it's been
capital
under
partners.
10. Yeah, so far it's been under 10. I don't have, the most I have is 6.
6. Yeah. Okay. Great. And how closely can they work with you, or do they want to work with you typically?
Yeah, so good question. So the majority are passive, are extremely passive. they, you know, hey, I'm going to the building today. You want to come to? Nah, just whatever. I don't really care.
Right.
Most people are very passive. I do have 2 actually on this next project that I have going on in Barrie, 12 unit. 2 gentlemen that want to, they like the passive idea of it, but they also want to understand and learn for themselves how to operate, how to manage. So I'm doing this kind of a program where it's a learn and earn, basically. So they're capital partners, they're investing in it, but I'm going the extra mile and kind of, you know, having monthly calls with them, monthly Zoom calls, and more frequently if they want, but taking them through, okay, here's what we're doing for financing. Here's what our strategy is for the next. So taking them through here's the checklist that we're using when we go inspect. Here's our due diligence checklist. So showing them, you know, our systems, kind of the peek behind the curtains, because they're interested in it. So we don't really, you know, my partner and I, we've talked about doing kind of coaching, and we do a little bit of it, but we found that, you know, we're spending most of our time just on the operation side of buildings and acquiring. And so that was kind of the hybrid that, you know, if you want to kind of see and kind of learn our system as a partner, we're happy to do that. And that's kind of been the best of both worlds.
Right.
So we have 2 people on this very project that are kind of taking advantage of our learn and earn type of concept.
Nice. Thank you.
Excellent. Yeah.
Can you talk about the market segment, the areas? Is it, you know, from Windsor all the way to St. Catherine, or?
Yeah, sure.
Can you talk about that, where majority you are going to invest if people have capitals?
Sure. So I have 3 buildings in Hamilton, 1 in Barrie. We're looking in, we have another one in Barrie, a 20 unit in Barrie that we're looking at, and a 20 unit in Hamilton and another 12 in Barrie. So I stick to, this is a great question, great conversation. I don't go to Windsor. I've looked at Windsor, not that I just, for the model that we're looking at. So Windsor, in my perspective, again, nothing against Windsor. I think Windsor has done people really, really well. There's more cash flow, so the cap rates are a little bit higher. So meaning that you're probably gonna cash flow a little bit more, but the upside appreciation over the long term, to me, isn't strong enough. Also, you know, in a market like Windsor, it's a little too volatile for me, right? So so it's great right now, right? But as you know, it's very tied to the U.S. economy, very tied to auto sector, you know, other sectors as well. But to me, it's a little too volatile. So the markets that we're actively looking in addition to Barrie and Hamilton, St. Catharines, yes, Cambridge, Kitchener-Waterloo, Barrie, and Hamilton and surrounding, Brantford's in there as well. Markets that have strong economic fundamentals, good GDP, good population growth, good transit system, rental demand is strong versus supply. There's been rental growth over the last number of years and projected to continue over time. And so those are the ones that we're focusing on. Now there's others that might fit those criteria, but there's a lot of buildings in like this, you know, St. Catharines, Hamilton, Barrie, etc. Now, those are high demand areas, right? So kind of goes back to, you will overpay a little bit, but again, these projects are not to, you know, make millions in the next, you know, 12 to 24 months. This is, you know, get wealthy over the next 5 to 7 years plus, right? And so these markets are very kind of good and stable for that.
Looks like you are following pretty closely the top 10 list published by the REN Canada or something like that.
Yep, I've been a REI member for 5 years, so
Okay.
that's exactly it, right?
Okay.
Don Campbell, right? So,
Based on your answer, I can tell, definitely those are the key points.
100%,
Economics.
yeah. So, I mean, especially my background as a market researcher, this is the kind of stuff I'd look at always, anyways, right? Is, for a brand to grow, where do you position and who do you position yourself against? And so, similar to real estate, right? Like, again, it's like, and again, as Don Campbell talks about, and I totally buy into this concept, pick a market that has as much, he talks about as many kind of protective rings as possible, right? Protective rings being economic fund, a positive economic influencer. So if GDP is strong, population's growing, there's business investment, there's rental demand, all these things lead to strong rental businesses. That's kind of where we go. Anything outside of that, now there's other markets that may also have those criteria that we're just not familiar with. We can only kind of really want to focus on certain markets. So
Mark, I don't know if you touch on this. I kind of came in late a little bit in the second segment.
Sure.
What kind of returns do the partners would expect for investing in these apartment building projects?
Yeah, so we when we do our analysis, we're looking for buildings that are going to do about 30%. Now, it doesn't mean that so 30% for the total building per year. That allows us enables our capital partners to get anywhere from 12 to 20%, let's say, right?
On cash?
Sorry?
Under cash investment?
Yes, under cash investment.
Okay.
Yeah. But typically, because we're buying undervalued properties, that won't come in the form of monthly cash flow, at least in the first year or two. Because again, our model is buy things that have low net operating income. The upside really comes up towards the end, right? Now there's refinances in between where you can pull out capital. So they're typically not investments for people that need the monthly cash flow, right? There are different markets for that. I think that's where you can get into a Windsor, you can get into Northern Ontario, you can get into Kirkland Lake. We interviewed a guest that does a ton in Kirkland Lake. The cap rates over there are 10%, right? So there's markets for that. We've looked at those. I just don't feel comfortable with high cap rate markets because of the volatility of those markets, right? Again, I like, super boring, investments that are going to pay, 20% in the long term. So
is that year over year return or just on a long term, like 5 year?
Year over year.
Okay.
So, yeah. So it's like 100%. It's basically double your money in 5 years.
Okay.
Yeah.
And are you looking to sell? Your strategy to sell after those 5 years, or like how?
Yep, good question. So it depends on the property. So for example, we have a couple buildings where we're targeted to sell. Now at that, so we had one actually that we just refinanced 2 months ago, where the initial strategy was to sell, but we were able to refinance so much money out that now that building is owned with no money in. So we kind of basically own this asset in Hamilton with, for free pretty much. This project that I have going on right now, which closes in July, that one we're refinancing in year 5, where our capital partners are pulling out all the money they put in plus a profit of 19.5% annualized, so almost double their money. We're going to keep the building, and we're just going to hold it long term because all our money's out plus profit. Why not just keep the asset?
Awesome.
Yeah.
And so, so these kind of investments, if I'm understanding correctly, is that you're making the money is on the refi or the sell, and there's no cash flow during, let's say, the 5-year term or whatever. You expect to get the money back.
Yeah, there's typically cash flow starts. So it's an interesting thing, and we covered actually in the last webinar that I did, right, where I show, what happens is, so let's say year 1 to 2, that's really when you're transitioning and you're kind of doing the work to get your net operating income up. at year 2, you can refinance, right? And at that point, you know, you're typically pulling out anywhere from, you know, 15 to 25, maybe 30% of your money. So over that course of the 2 years, you've now netted, you know, a 15% return, perhaps, let's say, right? So you have to ask yourself, everyone's different. You have to ask yourself, you know, do I need an investment that pays me out on a monthly, because that's going to be a source of, you know, income for me? Or are you, you know, is the investment asset class more for wealth building, right? If it's for income supplementation, then you probably won't see any of that until year 3, 4, and 5. The Barry example that we just showed on a webinar, actually, what we showed was that, you know, sometimes people are comfortable with 6% cash on cash return, or 7 or 8. In fact, this project hit 7, then 8, or sorry, then 9, then 12, I think 11 in year 5. So now you can continue with 11% cash on cash return, kind of for the longevity of this thing. Or you can refinance and take all your money out and do something else with it. So it becomes a it's a trade-off. So you can have cash flow, right? But your money stays in the project, or take out your money and kind of just restart it over again. And again, there's kind of more nuances to that, but it is a trade-off. It is a trade-off, depending on the project. Again, if you want a high cash flow market, then you're probably not in a market that has strong economic fundamentals, in my opinion. If you want cash flow, then you're keeping a lot of your equity also in the building, because on the refi, you're essentially taking out all your equity, paying yourself back, right? And you know, a lot of people talk about, well, let me take out 80%. Cool, you can do that, and we do that too. You can do that, but just realize that when you do that, your financing charges also go up, because your mortgage is now that much larger, right? So I think this idea of cash flow is an important one to really dissect and again, everyone's different. You know, that it starts when we talk to people, what are your objectives? Do you need, is it for cash flow? Is it going to supplement an income? Okay, cool. Then these buildings aren't kind of really kind of for you. Maybe there's other strategies for that. But if you're okay to defer some of that, you know, income for the trade-off of just, you know, stronger growth and wealth, then these are the types of, you know, projects for you.
Okay, yeah, that's really interesting. Anyone else have any more questions?
Hey, this is kind of a bit of a weird idea, not really, but you know, with have you guys looked into like converting like industrial or like office spaces into apartment buildings?
No, I haven't. I have not done that. We've looked at, the closest to that we've come is where we have in some of our buildings today, actually one that we're looking at the other day in Hamilton. This was a 12 unit with 2 commercial units in it. And there was a very large kind of empty space of just converting some of that back into residential. So that's kind of as far as we've gone. We haven't taken kind of that leap in terms of complete conversion of an asset class into another.
There's like schools in Hamilton that, you know, like Stinson. I know Stinson's done something like that as well.
Yep.
So just kind of interesting note. Just wondering.
Yeah, absolutely. No, we haven't. Yeah, haven't done that.
Mark, just a final question for me here. So so let's say the investment that I've done, let's say for cash investment, of course, you know, I'm not telling you that there is a bank behind me giving me the line of credit for free there. So in regards to, let's say I'm putting my money from other properties that have a huge availability on line of credit. So are you saying that the payout to me will be 5 years after? So that means from now till 5 years, I'm gonna just have to figure out how to pay that interest on the line of credit. Can you clarify that? I didn't get that. Yeah.
Sure. Yeah. So in all the projects we've done kind of so far, and even this kind of newest one, we've refinanced. So we take the first, let's kind of give it 2 years to turn as many as we can, and then we refinance that incremental value that we've added in the first couple of years, that goes back to pay, a portion of our basically return of capital. So that capital can be used to then, if you put that in account, to fund the interest payments on lines of credits. We have come up with creative arrangements in some previous projects where investors, were in, and we had some cash flow. We paid some of that out just to cover, and then that would just come off of your return on the end. So really, it's on a project by project basis. If there's a need kind of for that, HELOC interest payment, we can try to figure something out.
Okay.
If it can be supported by the building.
Okay, yeah. So that's great. I don't want to have a Scotia calling every morning to say that I haven't paid my line of credit.
Yeah, for sure.
Thank you.
Yeah.
Sorry, quick question. As the syndicator, are you doing acquisition and management fees as well for the properties?
So we're doing, good question. So we've done two models. So we've done 50-50. So in one of, actually two of our buildings in Hamilton, we've done a 50-50 joint venture partnership. So 50% ownership, capital partners own 50%. They come up with 100% of the capital to purchase, no fees, right? And so, we're, as managing partners, we're getting paid on the equity on the end. More recently, what we've done is we've shifted to, and our most recent project actually is 75-25. So capital partners get 75% ownership, but we're taking some fees up front for that in lieu of that. And so that just helps with, again, the acquisition, the time that we're spending, on the acquisition. Like, for example, to get to this one in particular Barrie project, this was probably the fifth one that we seriously went after, analyzed, lost the last four due to overbidding, etc. So there's a fair bit of work. So we take those up front, and the benefit to the capital partners that they own a substantial proportion more of the property.
One more for me, if you don't mind. So I was speaking to one of business owner here in Brampton. So a long time ago, he made a comment to me because I was investing on primarily single-family homes, right? And then I approached him because he owns hotels and stuff like that. He's a long-time investor. Then I asked him, I said, I was looking for properties between 6 to 10 units or something like that. His answer was, nope, look at 12 and up. Can you elaborate that? Because we think commercial starts at 6, right? So 6,
Yep.
to 10 units. But his point was, it's after 12, that's where you start making good money.
Yes. Yeah. So I agree with that concept. For example, I just looked at, just for fun, like an 8-unit that was passed across my desk. We're going to go buy. I was looking at it for somebody else. Actually, they wanted kind of a perspective on it. And it's so in the value adds. So a couple things in the value add strategy, the model, your big lift is coming with improvements in net operating income. So with 8 or 10, for example, you can only move it so much. Right. So the more units you have, the greater the range of net operating income improvements. And so it just gives you more of a runway to grow net operating income. Whereas at smaller buildings, you're capped at the number of units that you have, essentially. So 15 is better than 12, 20 is better than 15. Absolutely. The other thing is, if you look at like cost of capital expenditures or maintenance, new boiler system, new roof, as a proportion of units.
Oh, right.
So you want to spread those capital expenditures across as many as you can. So from an efficiency standpoint, I also agree with the concept, just from a net operating standpoint, right? The more units you have, the more of an opportunity you have to grow net operating income.
Right. So basically, like boiler system costs you $5,000. 6 unit may not help you, but 12 unit will definitely carry it.
It makes sense. Yeah, it makes sense. It's the cost. The cost per unit is obviously lower now. So it becomes an efficiency and synergy calculation. So yeah, I would agree with that.
Makes sense.
Yeah, and it's not that 10 or 8 or 9 or 6 units aren't good, right? There's lots of people making money off it. It's if you're going to put in and this is actually why I moved from buildings from duplexes into apartment buildings, and why even in my flip business, I've stopped doing smaller flips, and I'm only doing $1 million flips, because the amount of work that goes into $1 million one is just a little bit more than the work that goes into like a $500,000 house. And so the margins are way larger. So same idea, just it's a scaling exercise.
Yeah, thanks for that. Yeah.
Mark, you were mentioning the split between capital partners and managing partners is 75-25. I was just wondering, do the managing partners actually have any cash in the deal?
So on this one, we've put in, so we'll put in not as much as the capital partners, but we have in, I think, as a group, like 75,000, like for down payment, kind of all of the upfront costs. We'll recoup that eventually towards the course of the project, as will everyone else. But yeah, we come in with that. And at the end, like at close, if we've only raised 600 of the 720, then our money goes. So we're prepared to close regardless of the gap on this project. On previous projects, I do have my own capital in there.
Okay. And on the refi, do the managing partners get paid out first, or you are just like the rest of us in the same capital pool?
Yeah, no, so the way we structure, so on the refi, it would be the preference, and it's all kind of outlined in shareholders agreement. The preference is to the capital partners, and then anything remaining. So it's basically capital partners first, then fund. First it's maintain a viable float account for the building. So that's kind of first. Then it's repayment of capital to capital partners, kind of a number that kind of makes sense. And then anything remaining, then it would go to operating partners. But for us on the refi, that's kind of not our model. That's not where we really benefit. The benefit is really in driving the ROI as high as possible for the whole building.
Wow, thank you so much, Mark, for all the information that you have provided us. It was so valuable. I think everyone enjoyed it.
Yeah, absolutely.
It's really good. It's really good. Thank you.
Hey, Mark, would it be, we're going to probably have to ask you back one day, if that's okay with you.
Definitely.
Okay.
When Sarah raises the 100,000.
Yeah, of course. Yeah. Let's do that.
Teamwork, guys. Teamwork.
So,
we'll raise the money for a building.
Yeah, 4% line of credit, and we can get Mark to turn that into a 30%. Why not?
So, Mark, can you just remind everybody how to, and maybe we can also do, I think Diana's got everybody's contact info. We can probably send a reminder in this West GTA, but maybe just a quick, let us know where people could contact you.
Sure, yeah. And I'll send this to you guys as well. So, I'm on Instagram and Facebook often. So Instagram or Facebook. So Instagram, Mark_Baltazar on Instagram. We also started a Facebook group specifically dedicated to apartment building investing. So Apartment Building Investors Network. So if you search that out, you can be part of that. We have kind of daily conversations about apartment buildings, whether it's myself, my business partners, or other investors kind of chime in. It's good. It's a really good kind of forum just to ask a bunch of questions and get answers or provide feedback. And I guess the other place is, my email, mark@peakpropertyinvestments.ca, website, peakpropertyinvestments.ca. Most of the webinars that I just spoke about aren't uploaded to the website yet, but they will be. But what I'll do, Diane and Mark, I'll send you guys a link. Literally just over the last 4 weeks, we've done 4 of them. 3 of them have been about how to analyze deals, how to grow net operating income, how to structure your analysis, all that kind of stuff. So The recordings are available. Feel free to, log on and check those out.
Beautiful. Thank you so much.
Mm-hmm.
Yeah,
Mark,
thank
I have
you
a
so much.
question.
Sure.
Because I invest in Niagara Falls. We currently have a hailstorm right now. Sorry. And I do have like a lead for a building, a 12-plex, but I was really surprised that he contacted me. Is there any way that I can contact you to discuss that building?
Yep. Mark at peakpropertyinvestments.ca. I'll give you guys my phone number too. 416-90. Oh, sure. You know what? You could probably get an email, but not.
Yeah, I'll send everyone a message of all your details, Mark. If you just want to send the email of like all the details that you want to send us, and then I'll just pass it on to everyone so we all have all the information.
Sure. Yeah, happy to do so. Yeah, no problem.
Awesome. Thank you so much.
Cool.
Yeah.
Thanks, everyone. This was good.
Yes,
great
thank you again. Yeah, it was great.
Great questions. Bye.
Thank
Great
you.
questions, and happy to do something similar at some point. Thanks so much, guys.
Looking
Yeah,
forward
great.
to
Thank
it.
you so much. It was it was awesome.
By the way, we need that 100,000. I was serious about it. That's the serious face, okay?
Yeah.
Bring the money. Bring the money.
I know you're serious.
I'm in Brampton as well, so we'll probably live close to each other.
All
Yes.
right. Wow.
Yes.
Wow.
Yes.
Look at that.
Yes.
Definitely.
That's awesome.
Yeah.
All right.
Okay, look forward to more in the future, guys. Take care.
Okay,
Thanks,
bye.
everyone.
Okay, bye.
Yeah. Thank you so
Thank you.
much. Bye, guys.
Thanks,
It was awesome
bye.
having you, Mark.
Yeah.
Pleasure.
Yeah. Thank you.